Hi, so let's take a look at problem 8-14. Okay, so the business produces and sells small storage and organizational products. During the first month, products sold well. The owner was surprised to see a loss for the month. Here's the statement showing the loss. She's discouraged over the loss because she had planned to use that statement to encourage for investors. A friend who is an accountant insists that the company should be using absorption costing rather than variable costing. He argues that if absorption costing had been used, the company would probably have reported a profit. Then we're given some data. And we're asked, compute the unit product cost under absorption costing. So product cost under absorption costing is going to be our direct materials, direct labor, variable manufacturing overhead, so those are given directly to us here. And it's also fixed manufacturing overhead. So we get that from the statement we were given our fixed manufacturing overhead was $75,000 in total. But we're looking at it on a per unit basis, so then we need to divide that by the number of units that were produced, 50,000. So $75,000 divided by 50,000 units gives us $1.50 per unit. So our unit cost under absorption method is $3.50. Redo the company's income statement for the month using absorption costing. So let's bring up the statement that was already done. Okay, sales, no change. Now, instead of breaking the expenses out with variable expenses and fixed expenses, we're going to do our cost of goods sold. So beginning inventory 0, brand new company. Add cost of goods manufactured. So we know that there were 50,000 units produced, and in the first part here, part A, we worked out the unit product cost. So it's 50,000 units times $3.50 per unit, which gives us 175,000. So that's the goods available for sale. Your beginning inventory plus what was produced. Then we have to subtract our ending inventory. So 50,000 units were produced, 40,000 units were sold. So that means we have 10,000 in inventory. So 10,000 units times the $3.50 that we calculated as our unit cost, 35,000. So if you take the 175, subtract the 35, our cost of goods sold is 140,000. So we subtract that cost of goods sold from our sales to get our gross margin of 60,000. Then we deduct our selling and admin expenses. Now right here they have them as 50, and that is our fixed selling and admin expenses of 20 and our variable selling and admin expenses of 30. They're combined here for 50, so we subtract those selling and admin expenses from our gross margin, and we get an operating income of 10,000. Then in part C, reconcile the variable and absorption costing operating income or loss figures. Always start with your variable costing operating income or loss. That's always what you put in first. So that was a loss of 5,000. Then we look at inventory. We produced 50,000, but we only sold 40,000. So our ending inventory grew. So because our inventory increased or grew, that means that there are fixed manufacturing overhead costs deferred in that inventory under the absorption costing method. So there were 10,000 units that were in inventory, and each one of those units, if we go up here in part A, each one of those 10,000 units that's in ending inventory has $1.50 attached to them of fixed manufacturing overhead. So instead of that expense being incurred on the statement this year, it's actually deferred in inventory until they're sold in presumably the next period. So that 15,000 gets added to the variable costing operating income or loss to come up with our absorption costing operating income, which is 10. So again, always start with variable costing, always look at what direction ending inventory went to determine if you need to add or deduct. And then you'll come up, your solution then will come up with the absorption costing income. Okay, we're going to skip number 2. You can read through that yourselves there in the solution. And we're going to take a look at part 3. During the second month of operations, the company again produced 50,000 units, but this time it sold 60,000 units. And we are to assume there's no change in total fixed costs. So we are asked in part A to prepare a contribution format income statement for the month using variable costing. So we're to use the same format that was used when they did their own statements. Okay, so sales, they sold 60,000 units this time, and $5 per unit, well, you can just work that out from the previous statement. There was 200,000 in sales, 40,000 units, so it works out to $5 per unit. Variable expenses, now again on an exam situation, I want to see your headings. And I want to see all this information. Don't just put in sales and a dollar amount. Actually show me how you're getting the numbers. Because, for example, if you had written in the wrong number of units or had written in the wrong price, but one of them was correct and the other wasn't, if you don't have it written in, you'd get 0 because this number over here, the total sales, would be wrong. But if you have one of these numbers right, you would get part marks. And I do allow marks for proper formats. So variable expenses, list that there. Variable cost of goods sold. Well, there were 60,000 units sold at $2 per unit. And where we're getting the $2, if you look back in part 1 here, under absorption costing, we said it was $3.50. The difference under variable costing is we don't have this $1.50 included. So it's just the $1, the 80 cents, and the 20 cents, which is $2. Okay, so variable cost of goods sold, 60,000 units sold times $2 per unit. Variable selling and admin expenses, again, 60,000 units sold at 75 cents per unit, and this comes from the information given in the book, 75 cents per unit. Add those together, you get 165. Subtract that from the sales, and our contribution margin is 135,000. That's our variable expenses. Then we have our fixed expenses. Fixed manufacturing overhead, 75,000. And fixed selling and admin expenses, 20,000. Both from our statement from last time, because it said there was no change in fixed expenses. So our fixed expenses total 95,000. Subtract that from our contribution margin, we get an operating income of 40,000. Part B says prepare an income statement for the month using absorption costing. So for the same month, but now using absorption costing. So again, sales are going to be the same. 60,000 units sold at $5 per unit. That was the sale price. Now we do cost of goods sold. It's going to be our beginning inventory, and we know from last time when we did part 1 here that we had an ending inventory of 10,000 units, and we also had calculated in part 1A that the cost was $3.50 per unit. So our beginning inventory is 35,000. Add the cost of goods manufactured. Well, it tells us that they produced 50,000 units, so 50,000 units times the cost per unit of $3.50, 175,000. So goods available for sale then are 210,000. Now, in the first month, they produced 50,000, sold 40,000, so they had 10,000 in inventory at the beginning. So they had 10,000 in inventory, plus they produced 50,000, so that gave them 60,000 units, but they sold all 60, so now there is no ending inventory. So we take our sales and subtract our cost of goods sold to get a gross margin of 90,000. Selling and admin expenses, 60,000 units sold times the variable selling and admin expenses here of 75 cents per unit, plus fixed selling and admin expenses of 20,000. Gives us an operating income of 25,000. Then we are again asked to reconcile variable costing and absorption costing. So again, always start with variable costing operating income, which we calculated here as 40,000. Look at what happened to inventory. We started off with 10,000 units in our inventory. It went down to 0, so our inventory shrunk. That means overhead costs, fixed manufacturing overhead costs were released from inventory. So therefore we deduct fixed manufacturing overhead costs released from inventory under absorption costing. So the amount of the change, there were 10,000, it went to 0. So 10,000 units were released, and the amount of fixed overhead in each one, we had already calculated back in part 1, there was $1.50 of overhead in each unit, attached to each unit there. So it shrunk by 10,000 units. There was $1.50 of fixed overhead with each unit, so that means 15,000 gets subtracted, and that leaves us with an absorption costing operating income of 25,000. So I can't stress enough, this is something that's very likely to show up on assignments or on tests. Start with variable costing income. Look at what happened to inventory to determine if the fixed manufacturing overhead costs need to be added or deducted, and then you will obtain your absorption costing operating income.